bets on though, because we weren't sure what was going to happen, and we only like to bet when we're sure, tempting though something may be. All right, so what did we say this morning? What was I talking about? You know, the thing is, the Fed is too disruptive to make a bet. So yesterday, if I can find another instance of the site. Oh, hang on one second. All right, back. Okay, so what was I going to say? Yes, Tuesday, right? So yesterday we talked about this. Is real important stuff, though. So let's go over it. Okay. Go a little bit bigger. Control plus. All right. So look, yesterday, look, for weeks we've been talking. This is a 20% line. It's very simple. This is the top of the range. We really don't expect in the long haul. Oh, I cannot believe I just did that. Wasn't that fun to remember what I was talking about last week? Even though I rebooted the computer, it still has all my things from last week. So in the long haul, FinViz, we do the futures. We do the indexes. All right, we do the S&P, and we do monthly. So in the long haul, that's a weekly look. It's all the same pretty much. Okay. In the long haul, you have a channel. And this is generally a rising channel. You can pretty much draw a straight line going up there, and you know where the tops of the range is, right? And then here, you know where the bottom of the range is along this bottom line. So when something is way too low, you know it's a good time to buy. And when something is way too high, wait, if you draw the channel, it's really only here. See, it doesn't get out of control. I wish I had a stick like thing I could do, but it doesn't do that. So, you know, you got to imagine a straight line going this way. And so this is all, you know, it's a little crazy, but that's because we keep throwing money into the market. But if you draw a straight line, I mean, you say, okay, so here's the top of the channel. And the top of the channel continues. But now all of a sudden here, it starts getting a little choppy and crazy. You're breaking too high in the top. So now you know you're at the top of the channel. It's a good time to short. And here's a good time to short. And here's a good time to short. Whenever you're over the top of the channel, it's a good time to short. Okay, that's when we make our short bets. That means that really in this track, pretty much, maybe here, you know, if we're watching this trend line over here and we extrapolate it here, it's still really not even a time to short. These aren't times to short. These aren't times to short. But when you get over here, suddenly, oh, look, there's a time to be short. It's touching the top of the channel. So you might say it's going to pull back a little bit. Lo and behold, it does. How much does it pull back? 20% of the run, maybe. That's fine. That's what you're expecting to happen, right? So now go back. Boom, 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 boom. No reason to short, no reason to short. Top of the channel, short. Top of the channel, short. Top of the channel, short. Top of the channel. That's how we know how to bet. I don't need the chart to show me a downtrend to know that this is the top of the channel. Now, unfortunately, this is a monthly chart. On the weekly chart, this is all happening here. Going back to August, where we've gotten very bearish, right? And it goes up and it goes down. But when you think about it, what's actually happening here? We've got a big toppy thing going on here. And this is just a little weak bounce within that zone. This is this. See this? That's where we are now. We're in the, oh, that wasn't so bad phase of the fall apart. Okay, and this is what I'm worried about. You're not 100% certain. It could be one of these. It was no big that here it wasn't so bad, and we get back up, and then we keep going. But probably due to the overall ridiculous valuation of the markets, due to the fact that this is our 20% line, and it hasn't thoroughly consolidated yet, totally rejected at the 20% line, all the way back down to like the 10% line, back to the 20% line, and now very possibly another test here. If we stop here, we're good. We're good for a full move. Oh, I'm sorry, it's not the 20, that's not the 10% line, that's the minus 10% line. 2850 is the must-hold line. Must-hold line's right here. That's the real line for the S&P. That's the value line as determined by me. So, take it for what it's worth. But that's where we think the real value of the S&P is, given all the conditions we're currently under, taking into account trade war with China, taking into account the virus all over the world, taking into account the slowdowns, taking into account global warming, which I know nobody takes into account. We talked about it this morning, but taking into account the fact that the planet is falling apart. How do you not take that into account? And, you can party like it's the last days of Pompeii, which is fine. And by the way, that was my advice to my children. I'm like, have a good time. Because they're like, well, Dad, what if the world's not going to make it? What if what if it really doesn't last more than another 100 years? I'm like, well, then enjoy the 100 years you got. That's your whole life. Enjoy what you can. Make some good memories. Go out and live your life. Be good people. What else are you going to do? If we're too far gone to save it, we're too far gone to save it. But that's no reason to withdraw into a shell early. But still, point being, how do you not take that into account? How do you pretend that doesn't have repercussions? There's lots of things that matter that we ignore completely, but that's a big one. That's a crazy one. And like I said this morning, here's what we're ignoring. This is some really, I don't want to be downer, but this is some real stuff, folks. So, 2 major glaciers are tearing loose in Antarctica. These are massive, massive glaciers. They have already caused sea level to rise 5%. Now, I don't get that number. I think that's a weird number. What is 5% of sea level? The sea is 7 miles deep. So if it rises 5%, that's like, I don't know, 0.35? Is that right? Yeah. There's like 0.35 of a mile, which is a lot. I think I can do my math calculator. So let's see. The sea is 7 miles deep times 5,280 feet in a mile. How's that for remembering my college stuff? Okay. And then we say times 0.05%. So did the sea rise 1,800 feet? No, that'd be crazy, right? So that's certainly not the right number. So what does 5% mean? I don't understand that. How can sea level rise 5% based on what? So that's a weird number. You have to take these things with a grain of salt. When you read an article, you got to think about these things, right? What do they mean by 5%? What is that? What is that number? But the number that does matter is ... Here you go, 10 feet. That's what matters. That's the number you can get into your head. 10 feet. It hasn't risen 10 feet. It's risen 5%. I don't know if they mean 5% of the 10 feet yet. I don't know what the frick they mean. But reassessment, blah, blah, blah. Oh, it's an abstract. Thanks a lot. Thanks for the science, guys. All right, we don't want to really read that right now. But anyway, you see, these things are all, when you have actual facts and science, they back it up with like scientific research papers and like, oh, here you go. If you doubt that question, here it is. But here's the problem. We're screwed. These ice shelves that are the size of North America are collapsing into the sea. And I don't know if this is going to work, if you guys can see this, but these are just massive, massive glaciers. And over time, I don't know how well the video is resolving, but these pieces of ice break off and they melt. They break off the glacier and they start to melt. And it's melting underneath too. It's worse than you think because it's also melting underneath. Because iceberg, and you guys know this, but let's just remember that that's what an iceberg is. So an iceberg is 80%, 90% under the water, 10% above the water. All Right? Now, that's okay though. That's the good thing about global warming, because if it was all like that, we'd be screwed. But these glaciers are mostly over the water. They're massive amounts of land over the water. They're not so much under the water like an iceberg is. But when they break off, this is what happens. They fall into the sea and they become icebergs and they start to melt. And when they, but as soon as they fall into the sea, this is what they realize they got wrong. As soon as they fall into the sea, they already increase they displace the water. They don't have to melt. It's as soon as they fall in the sea, they don't have to melt yet. But then they're going to fully melt and integrate, and it's not good. It warms the sea. It creates a vicious cycle. And what's happening is these currents are forming underneath the glaciers that are eating away at them from underneath. It's like shooting warm water up underneath the ice shelves. But look at these things. That's insane, right? And this is what's happening. When an Arctic iceberg the size of a country breaks away, what happens next? You can't even think about the scale of these things. It's just ridiculous. This is what's happening. These were perfectly safe and permanently frozen, and now they're breaking apart and drifting into warmer waters and dissolving. And every time that happens, it's a disaster. And that's a picture of the icebergs. So that's what they call caving, claving, something like that. You know, this is crazy stuff. This is an ice shelf breaking away. And anyway, so bad stuff. Things you should not ignore. Let's put it that way. These are things that you should not be ignoring, because this is how we are going to be totally screwed. So, and I don't know that you can actually fix it. I don't know that anything's going to be able to. I don't know if we'll be able to stop it. I don't know what we're going to do. But then you get slapped in the face with this kind of stuff. These are projections. There's an article linked to here too. These are projections for where in the near future, like in 2050, basically. Not, it's already 2020. It's not too far. We'll probably be alive for that. So in 2050, these dark places are places set. Look at this. Days at or above 82 degrees Fahrenheit, 70 days. So these dark spots have 70 days, 3 months of the year above 80 degrees. It becomes too dangerous to be outside. They can get so hot, like California is now, 120 something. So hot you can physically become ill from just going outside and walking around. This is in America. And then we're not talking about the desert. We're talking, look at this friggin' Louisiana and whatever over here in Arkansas. This is, and I don't know if it's Florida, all along up here, which is weird how hot it's going to get over here. California, of course, is already hitting these crazy numbers. Then it says, and then meanwhile, here's California here. And then here's California here. This spot is going to become uninhabitable. But look how far inland that is. That's crazy. This is going to be high tide. High tide is going to go this far in. San Diego is going to be wiped off the face of the earth. So will most of the West Coast. So will most of the inhabited part of California. So is all of the Panhandle in Texas. All this stuff up here. All of Florida is along the coast. Look at Florida. Look what's left. This little island is going to be left in Florida. Orlando's still going to be there. Disney will still be there. But we'll have to take a boat or a plane to get there. No more driving in Disney. So this is 50 years. Not 50. I'm sorry. It's 2050. It seems like 50 years. It's 30 years from now. In between now and then, it's not going to be like boom, snap your fingers, and that's what happens. Between now and then, this is what's happening. Don't buy land. Don't buy property here. Don't buy property here. Don't buy property here. Look, there goes New Jersey. New York is gone. Long Island is gone. Massachusetts is gone. We've made it worse. In the last 4 or 5 years, it's gotten worse because we've done nothing, and Trump has gone backwards and made things worse than they were. And we couldn't afford that. We voted for this. We voted to say, screw it. And now it is happening. So it's already showing signs of accelerating rapidly that this problem is happening. Now, the worst thing is that I saw, though, was these are all places, percent decline in farm yields, 6.5, 13, 44% decline in farm yield. Is that 80 or 90? That's a 90, I think that's 92%. Dark purple, 92%. Unfarmable. No crops, all dead. Barely, really unfarmable. You wouldn't, why would you put a farm there? Now, it's good for, it's plus 20% up here. All of a sudden we get more farming up here. So we're gonna have a nice green belt here. All right, there's gonna be some nice areas to go. There's certain places that'll benefit. This makes no sense because this will be underwater, but because I guess because of the water, all this land becomes a better place to grow. So good for the grapes. Good for the marijuana. We're gonna have plenty of marijuana and plenty of grapes. That'll be great. And I mean, it'll move the breadbasket. It didn't do Canada. Canada's going to hugely benefit from this stuff. Canada's going to get a warmer climate. They're going to get a better climate. They're going to have a nice, better crop yields. They'll have a better rain season. Everything in Canada is going to get better, basically. So, so bet on Canada for the long haul for the next 30 years. And it's not their fault. It's just going to get imperceptibly better. Everybody's going to have to move north. Russia is going to become a paradise also, which is why Russia is 100% behind global warming. And this is why Russia supports the Republican Party, and they support all the oil companies, and they do want to do anything they can. Global warming for Russia is victory. It's victory without war. Their country becomes the best country on earth. Other countries fall apart and die. Russia is very far north. It's a cold place. They don't care if it warms up globally. They're not really touching any oceans either. It's like a gigantic win for Russia. It's amazing. I think there was a global map here. Let me take a look. Yeah, look at it. Oh, you don't see much here, I guess. That doesn't tell you anything. But yeah, look. I mean, look at Canada. Look what happens up here. This is the best part of the planet now. It becomes around this area. We still have some of it. We're still going to be good in North of America. This becomes terrible down here. And that's where these maps came from. So if you go to ProPublica, the climate initiative, the regions where temperature, blah, blah. Did you guys lose the audio? Okay. So I can't move this thing. Oh, I gotta use this. No, it's not responding. Well, isn't that weird? Oh, I see. It moves while I'm doing it. Ha ha ha. Okay, I get it. I'm not very smart. All right. So the temperature precipitation has been most suitable for humans in the past 6,000 years. So we've been like this. This is what we have now. Incredible farming regions are here. So keep that in mind. It's not going to be friendly to you. The most suitable zone for temperature participation has been here in the U.S. Now what happens? As climate warms, the nature shifts drastically northward, even under. See, I knew all this before looking at it. By 2070, much of the southeast becomes much less suitable, and then it moves towards the Midwest like that. So you see how Canada goes from this, right? And watch what Canada does. Forget everything else. See that? It starts becoming very nice in Canada. Then the nature moves sharply towards Canada. It says the U.S. is too hot or dry for the type of climate humans historically have lived in. What is that? That's not good. Whatever this is, it doesn't seem to work. Oh, and then it gets into these maps. So by mid-century, A will feel like Louisiana does today, like southwestern Arizona. We'll see soaring wet bulb temperatures because of factors like sun angle, wind speed, cloud cover, reacting to high temperatures, blah, blah, blah. Wildfires, 2040, 2071, we have them now. They're saying, forget those. We're going to have bigger, much bigger wildfires. We can do way better. Sea level rise 2040 to 2060. 2040. Crop yields, see, all these, like I said, all these things were from 2050, basically. Economic damage, blah, blah, blah. Anyway, horrible stuff. So are we taking that into account? Are we actually thinking 20 years ahead? Are we investing 20 years ahead? No, obviously not. Okay, we are partying like it's 1999. Oh, and look at that, it's dropping down. Where were we? What were we talking about? Oh, I remember. Tuesday. So, and here, and here. So look, we know this is a free money era. They've been printing money up. Rich people have been getting unbelievably rich. That still doesn't mean you can't top out. So this is still toppy, and I still have reasons, which I just illustrated, to be cautious. I have reasons to think that this is a very, very strong upward trend line. And so when we hit the bottom of that upward trend line, which is 3,000-ish, 28, in fact, it is currently 2850, okay? When we hit the trend line and the bottom of the trend is 2850, which was our target price for the S&P at this time. We've been targeting 2850 since it was down here. We said we were going to go to 2850. We're past 2850. That makes us bearish. We're higher than we thought we should be. But by the way, 2850 is the must-hold line. The must-hold line means we could go 10% down or 10% up, and we're still in our trading range. 2850 is the middle of your trading range. It's not the top. So I don't mind being at 2850 plus 10%. 3135, I have no problem with that. Here's 3135. That should be the top of our range. So that means we're really getting into excessive territory here. And as we know, 3420 is completely unacceptable. That's a 20% line. That's too high. So that's like when you look at these charts and you say, okay, well, it could be one up easily enough. But how often does it really go two lines up? Well, look, RB's doing it today, gasoline. How often do you go two standard deviations up? Oil's doing it, gasoline's doing it because of that report. But like I said, we're shorting this, or I want to short that. Oh, we can short it right now. So I said that's too high. It's above two standard deviations up. There's not a good reason for it. The report wasn't that strong. We'll look at that next. The whole market is like that, though. You have to understand when you're too high, don't make bullish bets anymore. And I don't mean short everything. I just mean stop making bullish bets when you're too high. There are still individual value stocks that you can go for. Like this morning, we just talked about who was it? Oh, I already forgot. Ugh. Don't like going senile. Who the hell are we talking about? Oh, it's because of global LNG. I remember. Haha. LNG. All right. Because we were talking about LNG because of the global warming. That's why I was talking about it. Oh, look at that. 51. Holy crap. Did I do that? So we were talking about LNG, and now it's up 6%. And again, you can see like 50 is a very good trend line for these guys. They're finally going to break out over it. They're going to have a hard slog going through these converging lines, but they have moved up, 50% recovery, consolidated, and now they're ready to move up and get back to normal. They're undervalued, good company, strong growth potential. And what I'm saying is that when we know this is happening, and we get, this is real. And it's not just real in America. The whole world looks like this. So this isn't just about us. This is everybody. Everybody signed the Paris Peace Accord. They're actually, the rest of the world, they didn't stop the Paris Peace Accord or the climate accords, but they put them on hold, waiting and hoping. The whole world is crossing their fingers and praying that Donald Trump doesn't get reelected. If he is reelected, they're going to go on without him and start imposing penalties and sanctions on the US for not following world climate policy. Biden's going to get in, though, and Biden is going to right away say, okay, we now have an emergency. Thank you, Mr. Trump. We now have a complete and total emergency, and action has to be taken. That action is not going to be good for business. That is going to crack down and disrupt a lot of industry because we waited too long, and now we can't do it the nice way. It has to be done the harsh way. So acting like babies and refusing to sacrifice anything, refusing to fix the problem, has let the problem become so bad that we now have to take emergency measures if we're going to have any chance of stopping it. And so it's bad for some people, but it's certainly going to be good for LNG because you can't do anything drastic. Solar isn't a drastic now solution. Getting everyone an electric car is not a drastic now solution, but LNG and converting energy sources to LNG to use this instead of that. Well, let's take World War II, for example. And in Germany, let's say, they started using coal, and they started they had lots of coal, but they ran out of oil. So what do? They converted all their machines to coal, or not all of them, but a lot of them. And they converted a lot of their machines to run on coal because they had coal and they had wood. And they chopped down their forest and they mined up their coal, and that's what they used to fuel themselves because they didn't have any oil and nobody was giving them any oil. So that's what they did in World War II. It only takes a couple of years of when you have a real will to act behind you, it only takes a couple of years to do some massive conversions of your power infrastructure. That's what's going to happen when Biden comes in. Biden's going to come in, the whole world's going to sit down and have a rational conversation for a change about what we can do to address this problem. And what we have to do to address this problem is anywhere we can, we have to eliminate fossil fuels. Anywhere we can, any way we can, no matter what it costs, it has to be done. And that's what we're going to have to look at. And it's hard because you know how selfish people are and how crazy people are. You think about, are we really going to do this? But then you look at a country like Holland, which is basically under sea level and surrounds themselves with walls and dikes and dams and blah, blah, blah to keep the country dry. So on a national scale, for hundreds of years, they have been fighting the fact that they shouldn't even be there. That whole country should be a lake. So they planned ahead. They did what was good for the community. They spent what it took, and they made their place habitable when it probably shouldn't have been. So can it be done? Yes, it can be done. And do people have the will to do things like that? Yes, they do. It'd be interesting to study it more as far as like what kind of descent did they have early on, so on and so forth. I'm sure there were rich people in Holland who didn't want to contribute to saving the future because they could just leave, whereas other people see it as their home and they want to protect it. We have that going on right now. But the point is, to me anyway, it can be done, therefore it will be done. Therefore, the people have the will, and eventually people start waking up and fighting for things like this. When something is critical to the long-term survival of the species, people tend to get together and do what they have to do. So that's what I think anyway. So it's the bottom line. I think that there's going to be a massive push for LNG under Biden. I think it's going to, and I don't mean just under Biden, I mean, without Trump resisting, the rest of the world wants this. So you're going to lose the last bastion of holdout other than Putin. You're going to lose the last guy who's trying to stop the world from moving forward and cleaning everything up and fixing the climate. if it can be fixed. We don't even know that though. Until we really start trying, we don't really know that we can stop what's happening now. It's really bad. But if it can be fixed, then that's what's going to happen next. So I think LNG makes a good investment, and our investing premise on LNG, which I forgot to make a top trade, but I guess top trade people see this. Right? Because if you're a top trade subscriber, you do get the weekly, the daily newsletter. So very simple trade. It's at, well, now it's at 50, but it was at 48, and we just sold 5 puts for $5. That's it's actually $2,500. I mean, a math error. Ha ha ha. Because it was full. Because there's a 4 there that screwed me up. So it's 5 puts for $2,500. So actually $500 less than this, which is nice. And you're buying 10 calls for $1,450. That math is easy. 14.5. And here's 720. So it's $7,200 for the short calls. And your net here then is $4,800, and you have a 10,000 upside, so it's like a 200% upside. And all you have to do is be over 55, and lo and behold, it only takes a day. The same day I say it, we're already heading back to 55. But what's my projection? In 18 months, I'm saying we'll keep consolidating, but in 18 months, we'll certainly be on the higher side of this because Joe Biden, the rest of the world, we need LNG. Cheniere is in the position to be a massive supplier of LNG. They've got terminals, they've got ships, they're ready to go. Okay, so if people want to take this thing seriously, this is going to be one of your inputs. And as I said, and again, somebody said to me yesterday, where's the news, whatever. It's like I do read the news every day. I don't always get around to putting in the PSW, but today I was reading my news and it came up. And what was the article? Did I put it? Did I place it? Things that make you go. Yeah. Abu Dhabi took a $61.5 million stake, which is 5% of the company. So I saw that. Now, you can read the news all day long, but you gotta know what it means. But I saw this article. Because it was Bloomberg, I always read Bloomberg, and the Sovereign Wealth Fund of Abu Dhabi. Now I know there's several factors here, so I'm reading this article. I know that was a good chunk of Cheniere. Well, it says 5.1 anyway there. I know Abu Dhabi, when they invest in something, they tend to push and follow on. They don't like passively invest. They tend to push to build, and they'll lend money and they'll do whatever it takes, and they'll help them do M&A. So they're very active investors. So they're a good partner. So it's not just that it's Abu Dhabi investing. I know what they do. I know the people there. I know how they do their deals. Now they're becoming a major shareholder, and that 5.1%, by the way, that triggered the notification that they're an investor. It means they're increasing their stake, and they had to notify that they probably didn't stop it. If you were going to be at 5.1%, you wouldn't be. You'd be at 4.9%. You'd keep it quiet. So the only reason they went to 5.1% is because they're pushing their holding past that limit, because there's reporting requirements at 5.1% that you really don't want to deal. You don't want to deal with being a 5% shareholder if you don't have to. But once you do, the chances are you're not stopping at 5.1. You're probably moving towards something like a 10% investment. So they're accumulating. They're putting more money into it. We know Cheniere's on a good path. We know they have tremendous potential in their terminals, and we talked about them for years that we like this company, and so that's why this particular day today, that just triggered it in me, because it was on my list anyway of people who I liked that were kind of cheap, but we missed them on the dip, and then we missed, when we missed them at 30, and I wasn't too keen to jump in at 50, but now I'm like, okay, well, it's going to be too late. It's not going to come back. That's what I'm worried about. I'm worried about it never coming back. I think this is going to become a pretty solid floor, like 45, 50 range, because now they've got a big investor, and now, new big investor. Now they've got, and the Biden presidency is going to change things, and they may set up a whole policy thing from now on. We're going to do this and that with natural gas. So we just want to be part of that. Oh, it's the Fed time. Okay. Phil, the article says that glaciers will contribute 5% of the sea level rise, not a 5% rise in sea level. Well, what contributes to the other 95% then? That's interesting. Or these particular glaciers, is that what that means? Located along the coast of blah, 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 enormous pine island rates contribute around 5% of the global. Okay, so those particular glaciers, yes, glaciers in general, but I get what you're saying. If you like LNG, would you recommend UNG plays? I don't like UNG because it's a crappy ETF. It has a horrible fee structure that it turns over all the time because they're constantly buying and selling futures contracts. And it means that they're always rolling over and incurring a lot of expenses. So it's a very terrible ETF to hold. I used to like Chesapeake, but they got crazy. I don't know what they do now. Oh, they're gone. So they finally went bankrupt. So I used to like Chesapeake, but that's the problem with them. There's pipeline plays. I like the gas pipeline plays, but I don't think I want to own. You know, I like this. This is liquefied natural gas. That's the forefront. And it's going to become a massive export for the U.S. It's going to become a massive export for other countries. You're going to see these tanker ships of theirs going back and forth from country to country carrying LNG, and there'll be more and more demand for it all the time. So, and we have an incredibly huge supply of this stuff, so it's not going to run out. So it's a great business to be in. What does LNG do? They buy supplies at wholesale, obviously, from the natural gas companies. They take the natural gas in through the pipelines, which is why I like the pipeline companies, and then they compress it and take it to where it needs to go. So they take it from where there's a lot of it to where there's not a lot of it. That's their business. They get paid. They're basically specialty shippers. That's what they are. They are specialty. They're not a natural gas company per se. They're a specialty shipping company. But they do something that nobody else can do. You can't say, it's very hard to compete with them because they've invested tens of billions of dollars in infrastructure of these systems that compress the natural gas and put them in these specialized tankers and send them across the sea so that they can transport them safely. And they've already worked out the logistics to be safe in the harbors and not kill people. Because if one of these tankers ever blows up, it's going to be spectacular. It's going to be like atom bomb kind of explosion. It theoretically shouldn't happen, but you know, it is a possibility. So they actually have like unloading in the harbor, like they'll stay miles offshore and unload their tankers through a pipeline system that's like an offshore oil rig that feeds a pipe. It's the same kind of thing. So they're going to pipe it in from a distance. They're not going to pull up in your neighborhood and unload natural gas like that. That's crazy. So they're just way ahead of the game on all this stuff. They've got the terminals, they got the trains, they've got the cargo ships. They got everything set up to do what they're doing. And now you're going to have a rush for natural gas, I think, and that's going to cause it to expand rapidly. LNG, the 23 are out. Why were these not chosen? LNG, the 23 are out. Why were these not chosen? Oh, 2023. I didn't look, frankly. I'll tell you the truth. I did not even look that far. Was it in Thinkorswim? LNG? If Thinkorswim didn't have it, then I didn't look at all. Oh, see, it wasn't open. That's why. There's the answer. Had it been open, I would have probably looked at it. How much better pricing is this? We saw the 40s. It's the same money. Why would it be the same money? Oh, it's not the same money. $7. Okay. Yeah. I mean, I don't know how well they're trading so far, but yeah, I certainly would do that. I'm comfortable though with this because I have a short, my premise isn't that long term. But you could definitely do it with the 2023s. Notice that there's hardly any sales for these. You see the last, there's only a last year and last year. None of these other blocks have even traded. So, and that's not why I didn't do it though. I didn't do it because I didn't see it, or I didn't consider it because I didn't see it. I might have considered it and still on with the 2022s, which at least has some action on them. At least people are bidding on them. Since you like LNG, what about pipeline? I just said that. Anyway, yes, I like pipeline companies. At ET, we have one of our portfolios, don't we? They pay a wonderful dividend. So they're all good. Any trade for M for 2023. Again, like, it's one thing for them to be out. It's another thing for them to be actually trading. The Fed's in 1 minute. I was gonna say, are we waiting for Powell or something? So Macy's has 2023 now too. Wow. I'll tell you, I love it though. When the 2023s first come out, they're very mispriced, so it's a good thing. So, $7, moving on up. You're basically playing Macy's not to go bankrupt. So if you go in here, you're going to be at net, 330, and if you go in here, you're going to be at net 4. So I would certainly take. You always have to think about this. What happens if I do the 5? If I do the 5 and I get it for 175, I'm in for net 325, right? That's my net. If I do 7 and I sell it for 280, I'm in for 420. So I get twice as much money, and I only get, and my worst case scenario is paying 50 cents more. So it doesn't make sense to sell the 5s when I can sell the 7s. And again, as long as that's my target. But if I don't believe Macy's is going to hold 7, why would I be doing anything with it? Why would I want to hold a stock when I think that the 5s are in danger of failing? Why would I shouldn't be in the stock. If I like Macy's, I'm not saying you force yourself to like something, but I wouldn't play it unless I felt strongly that was going to go. So that would start me thinking. I'd be like, okay, well, I don't want to do that. But I'm like, if I don't want to do that, why do I want to do this? If I don't like something enough to take more of a risk, why am I doing it? Now, as you know, I love Macy's. I think it's ridiculously undervalued. I think that one building of theirs in New York is worth more than the whole company's trading for right now. And where's that number? Nope, that's not it. Oh, there it is. Here's Macy's. Oh, yeah, nice bump today. So, $2.2 billion. And obviously I've been saying this since it was 5, because 5 was insane. Whatever that one. I mean, this was just ridiculous. So, we're just playing them not to go bankrupt. So if you want to play them, I would certainly do that. I would sell the $7 puts for, 280, whatever it works out to. And I would use that money to buy, I think I have a hard time going to 10, but since the 5, which is in the money, the 5s are 360 and the 10s are $2. So for $1.60, I can buy that $5 spread. That's wonderful return right there. You don't have to even why even sell something short? But I can do that for $1.60. I can sell, let's say I sold 10 of these for $2,800. And let's say I bought 20 of these. Let's say 30. Let's say I bought 30. And what did we say it was? $1.60? So 160 times 30 is $4,800. It was $1.60, wasn't it? Yes, 360 minus $2. Okay, so $1.60. So for $4,800, I can buy $35 spreads, $15,000 worth of spreads, minus we said 10 of these, right? So let's say $2,800. So I'm out there, not easy math. So $2,000. So I can buy a $15,000 spread on Macy's, and I do like this trade a lot. I can do a $15,000 spread on Macy's for net $2,000. So that's and what's your commitment? Even if you have an IRA account, all you have to do is buy 1,000 shares of Macy's for $7. So you're going to put $7,000. Your IRA margin requirement is $7,000. A regular margin requirement, you're going to be about $2,000, and you're using $2,000 cash to get $15,000 back with a $13,000 profit, or 28, whatever it worked out to. So that's a really good trade. Remind me that in the chat. Oh, look, the market's taking off. Okay, what are they saying? Fed says to continue Treasury MBS purchases at the current pace. Unchanged rate. They said nothing. This is why we don't bet Fed days, because it's stupid. That's apparently all they said. Fed on hold until inflation's at 2%. Set for moderate overshoot. So the Fed is not going to raise rates until inflation is at 2%. That's the most important thing to remember. Now, will Joe Biden keep Jerome Powell? Most likely. I don't think Joe Biden has a reason to get rid of Powell. So I think things will stay the same. So same ultra low rates, the same thing. They're still buying bonds. They're still buying treasuries. They're still buying mortgage-backed securities. Nothing has particularly changed on this thing. And there's really literally not, they're not even, other than that one statement, the Fed says to continue treasury MBS purchases at the current pace. That's apparently all they said in their statement, that there's nothing changed. There's no difference. It's the same day as it was yesterday, yet the NASDAQ is not up. The NASDAQ is down, but the Dow is up 230 points. The S&P is up 11 points. Not a big move, of course, but something, you know, at least it's being taken well at the moment. That's the bottom line. Macy's. L&G is doing what? How about IMAX? Remember IMAX? They're all back to the movies in China. I wrote about this, right? It's IMAX and Macy's. You can remind me to put up the plays for, but IMAX and Macy's both rocking and rolling. This is bang the table on both of those. China is back at the movies. They have no worries. They feel like they have conquered the virus. So, what's the dollar look like? Let's see. Do I not have it? Nope. DXY. What? Oh. That's right. Maybe it'll show up. DXY. I don't know. DXU20 September's over. So we'd be into the December, that's this one, DXE20. Still can't get it. Damn it. Oh well. Back to IMAX. All right, so gold, silver. Oh, I know where we got the dollar. Do that over here. Finviz. Currencies. Yeah. So nothing the Fed said here really bothered the dollar much. It went down a bit and then whatever. So there's no new stimulus. There's nothing else going on to weaken the dollar. So it's drifting back up. And if you look on a longer term, we kind of created at 92, which I said we would. I mean, we were talking about that last week. We thought that was a good place to go long on the dollar. I'm not a big currency player, but you know, you don't need to be a brain surgeon, right? It's like, yeah, that's a good line to go long based on what's been going on all month. You know, it's like pretty obvious that that's going to be some support. Longer term though, it's still in meltdown. Look at this. So it's nothing but a weak bounce, but you expected a weak bounce off this line. That's all. Nothing complicated about that. And you can see this trend line goes back way out to here, way out, you know. So support, although it broke, but it's still supported. Fail here. We had a bad few months. And then from then on, good, and support. And that means it's going to be a pretty tough line to cross, because even from way up here with that kind of downward momentum, it still bounced off pretty hard. So we'll see. But from 100, if you can see, throw this out from 100, which is obviously the top, and see, just because something is top doesn't mean it won't go over it. But 100 is a good top. So from 100 down to 92 is 8 points. That means your bounce is 1.6, 20% of that. So your 93.60 is support number one. And let's see if we can zoom in on that a little bit. So 90, look at that. That is a weak bounce. That's what the 5% rule does for you. Okay, 93.60 is the weak bounce line. You know that before it happens, but you have to learn how to measure things, because 100 to 92. So once you know what the drop is, and we know what the drop is because we know if we went back further in time, not that far, but if we go back further in time, we know 92 is support. So before it starts dropping, once it gets to 100, we say it's going to top out here. And where is it likely to go? Well, it's like, I'm sorry, you don't know it's going to go to 92, but you do know that it's going to retrace from the run. What's the run? The run was from 90, right? So the run was from 90 in the last 5 years to 100 with an overshoot and back down, back to 90, back to 100. So we already know it drops back. So now we have a range from 90. Now we have a range from 90 to 100. And that means we now know that 92 is at 20%, 94 is 40%, this is 60%, 80%, 100%. So we're moving in 20 increments basically. And that means that the weak bounce line, I'm sorry, the weak bounce line off of 90 is 92. So holding the weak bounce line means that you've got good support here, and that means you're probably building strength. The weak bounce line becomes support, and you never get back to the baseline. It means the weak bounce line is starting to become the support line. Then your next step would be 94, and we could see where we were at 94. It was somewhat supported, but that would be the strong bounce line off 90. But that's not where we really are. You can see where that's kind of shaky support. So 92 seems to be the good support right now. If we fail 92, that's going to be bad. We're going to go back to 90 and test that. But 92 seems okay. And that means we measure the run from 100 to 92, sorry, and that's only 8. And then we look at the 160 increments. And that means we would predict that 93.60, 160 plus 92, we would predict that that's where we would bounce to. And then here we go, and we look at it, and it turns out to be 93.60 right there. And when you know the 5% rule is working, now you know other things. Now I could tell you that now we know that there's a range from 92 to 93.60, that's the weak bounce. But even within that, you can now recalculate and say, okay, now it's a 1.8 run. 20% of 1.8 is 0.36. Therefore, we take 0.36 off of 93.60, and that would be 24. So 93.24 is a retrace of that, and then whatever we said, 3.6 below that. So roughly 92.90, which is right here basically. So 92.90 is where you expect to see a strong pullback. That's right where we are now. So if we're holding that line at 92.90, it means that we're probably going to bounce back and retest 93.60 again. And that's it. Very simple. You just recalculate the smaller amounts and you figure out where it's going to go. That's all. And it has nothing to do with the chart. That's the thing. This is not charting, it's math. We're only using the chart to illustrate the math. All right? Just like if a guy, with a, here you go, Einstein chalk board. Okay, so yeah, here, or even it's not Einstein, but whatever it is. Here you go. There you go. Oh no, forget her. She's a chemist. That doesn't count. You don't talk to chemists. Where is he? That might be real. Okay. So, you know, this is how my brain works anyway. So it's like, you don't draw pictures. All right. I don't know if this is real. It's hard to tell what's real. That's a pizza. I don't know if that's actually Einstein. That'd be kind of funny. I doubt it. Because it says pie and there's a pizza. But you know, this is how mathematicians think. They don't need the pictures. They don't say, "Ooh, and it would make a nice, pretty curve like this, or it makes a square." No, it's the math is everything. And I don't know if this is real. Let's see what that is. Possibly real. Looks like it's illustrating something. Probably looks like something to do with the curve of space or something like that. So they're not heavy on the illustrations. It's all about the numbers, and the other mathematicians look at the numbers, see the numbers. So what I'm saying is the 5% rule that doesn't seem like something he would have done. I don't know. Anyway, it's just math. And where are we? So, you know, when we're calculating these numbers, the chart's a nice illustration, but you have to realize it's just a complete background illustration of what we're really talking about. It's not important. The chart's not important at all. The chart has nothing at all to do with this thing. It's just something that you can see to illustrate how these things work. But the reality is you can run this all on a spreadsheet. If you went from here to here, what the chart is useful for, though, is to quickly take a look and say, where is my resistance line? But if I take a broader chart and I determine that the dollar since 2000, where's the baseline for the dollar since 2000? Well, clearly that's been the top of the range. So 90, 90. The bottom of the range has been 75. So we go from 75 to 90 in this decade until 2015. And something changed in 2015, or something changed here, and we popped over the range. And now are we establishing a new range that goes 15 points higher? Yes, we are. Look, we've moved into the next section. We've moved into the 90 to 105 range. So that now tells us that's our new range. 90 to 105 is the range we're playing in on the dollar. And that means 97.50 should be the midpoint. And we expect things to go up 750, down 750. That's going to be the range that we look at. Then we can run all our calculations from there, and that should tell us where things are going to be. But you expect to see strong support and resistance at 97.50 because it's the halfway point. Trying to nudge it in there. There it is, 97.50 on the dot. So 97.50, you should see good consolidation. You know, obviously, we're seeing that. All right. But that's where it's useful. It's useful for figuring out on any chart. And let's look at Macy's, for example. Oh, it's probably not going to be a good one. Macy's, and I don't have the grid now. But you can see Macy's was happy in a channel. Maybe if we can do Yahoo instead, it might be better. Bigger chart. Wow, down up 300 now. They're loving this stuff. Max. Oh, wow. Look at this time. Look how crazy that thing is. So Macy's is hard to predict, but from 2000, here's a crash in 2000. So from 2000, they bottomed out here. Take that. There you go. So they bottomed out around 12. That seems to be pretty good support, right? You see, well, I can't move this. I can't do my fingers. Look at 1993. Just imagine I'm pointing. I am pointing, but it doesn't help. 1993, 1994, 5, 6. Okay, it was along that 12 line. Went up. How much did it go up, though? It doubled, basically. Now, you have to, don't expect things to do more than double. So you look at 24, and you say, oh, there's 24. So here's 24. And you gotta find a stick that's right there. Oh, that was close enough. There. All right, 23.80. So there's the 24 line. So if 12 was a baseline that was support, which it was, see, in 2000 and 2001 and 2002, very obviously support. So if 12 was a baseline and 24 was basically the top, But then something happened into 2008, and we know what happened. It was the realty expansion. Probably Macy's was being seen as a realty play at the time. People were not shopping. That wasn't a problem. Everything was good. The economy was good. Everybody was refinancing and buying things. So that kept us going higher, and we went up from 24. The next logical spot would be 36 at that point, which is up here, there. And then that's what you'd say. So you expect to be, if you're into the next level, then 24 to 36 should be in play. We blasted past that, then collapsed because of Amazon or whatever. I mean, who knows what, I mean, such a stupid excuses for things. And then we come back, and now we are definitely in this 36 to 24 range, except we're not at 24, we're at 7. And then you say, should we really be at 7? Is Macy's really that much worse than it was 5 years ago when Trump was elected? Is it really that much worse than it was in 2012? Well, fortunately, I got my lovely macro trends here, and we can put in Macy's. And it goes back nicely. It goes back even further. It goes back to 2005. So in 2005, Macy's made $700 million income from operations. When they will go by net income. Net income, 700 million. Double that. They had a good year, 995, 895 to 900. A bad year. This was the crash, of course. They had a bad year. They lost $4 billion. You lose $4 billion, you wiped out the last 5 years of earnings. Like, so they made nothing for the decade. Then now we move on forward. Things get a little bit better. They recover a bit. 845, 1245, 13, 14, 15, 1. Now, what happened here? Why did it go from 15 to 1? Not really because they lost a lot of sales, but because they lost their tax break. Look at the income taxes. Wait, why do they pay income taxes? What on earth? I'm wrong. I was assuming that, but that's crazy. How do you lose $4 billion and then pay taxes? That's interesting. That makes no sense. Or maybe they just kept their credits, and like maybe they must have done something with their credits, because that's weird. Like, if they had to have a huge credit, it's not like they did something else. Anyway, so I assume they ran out of tax credits or ran low on it, but it's not really apparent from this thing. But their net income 627, 1566. That's very nice. 1.1 billion. That's pretty nice. So basically, they're not running at much different revenue than they have been, right? So now I go back to Macy's and I say, well, wait a minute. I can buy this whole place for $2 billion. And last year, because I feel like I'm crazy, so I got to look back, they made $1 billion last year, and I can buy them for $2 billion. That's odd. So obviously, now let's see now. So obviously they're going to do badly this year. You know, they're very unlikely they made much money or whatever. But we've seen them lose $5 billion and recover. We saw that happened just recently. So how much are they losing now? This must be as bad as 2008, right? It is. Look, they've got quarterly. So net income from continuing off. So here they are losing on April 30th. So here they made $500 million. Then they lost $4 billion, and now they lost another 600,000. So they're having the same problem they had in 2008. So what happened to the stock in 2008? big chart, big chart, big chart. There it is. So what happened to Macy's in 2008? It tanked all the way down to here, stayed down here for a while, tanked all the way down to here, stayed down here for a while, but then it went up and up and up and up and up and up and up, and it's a 10 bagger here and up. Now, do I think Macy's is a 10 bagger from here? No, I really don't give a shit, okay? I think Macy's is worth a damn sight more than $2 billion. I think they have a piece of real estate in Manhattan that's worth $5 billion. I think they've got other real estate that's worth about $20 billion. Totally underutilized. Now, you could think that these stores are a complete drain on them and they're never going to recover and blah, 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 which is exactly what people are. I'm pointing with my freaking thing. I'm pointing with I got a sticky thing here. No point to doing that. You can't see it. Fed holds rates. Nothing happened. They're really talking. They have nothing to say. All these people on TV. So the rates down here, they lost $4.7 billion here. This year's not over, but they're going to lose about the same this year. Then right after that, when they're finally going to writing things off, everybody goes, oh, no more taxes. We got this huge loss to carry forward. And then up you go. Same company, same real estate, same sales, same earnings. 25, 26, 27, 27, 28, 27, 26, 25, 26. It's the same company. They're dropping the same amount of money to the bottom line. It's erratic, but it's the same. It's just generally they'll make around $1 billion, maybe less than $1 billion. I don't care how much less than $1 billion. I'm only paying $2 billion for the whole company. And that's Macy's and Bloomingdale's that you're buying. I like Bloomingdale's. I like Bloomingdale's was not crowded. Actually, Macy's isn't that crowded these days either. Malls aren't crowded in general. But Macy's used to be crowded, and I always preferred Bloomingdale's in my mall in New Jersey because it was never crowded. They always, the second you walked in, somebody would be helping you. I love that. It's like, that's how I like to shop. I don't like the snooty stores, but Bloomingdale's is never like really snooty. They have really good stuff. They're not cheap, but they have good sales. And their people are like trained as good as like Saks or something like that. Like they train like a good New York department store. And I like shopping there. I always enjoyed it because I like to go to a place where I like just walk up. I'm like, get me that, get me that, get me that. Okay, thank you. Let's go. You know, that's how I like to shop. And I'll pay extra for that. I don't mind at all. I won't pay Neiman Marcus extra, but I don't like Neiman Marcus anyway. I like Bloomingdale's. Works for me. Anyhow, but and in no way, shape, or form do I make my decision based on that I like Bloomingdale's. I just feel that it's a good operation. It's solid. Macy's too. Macy's is a little bit higher end than the other guys, and Bloomingdale's obviously another step above Macy's. But on the whole, they are good old store operations. Oh, and Bloomingdale's has a huge place in New York that they own. That's another couple of $1 billion. You're talking about incredible real estate around the country. You know, I mean, Macy's been around for 100 years, more than 100 years. There's black and white movies about Macy's. You know, the Christmas one, Miracle on 34th Street, that's from like, I don't know, like the 30s, I think. I think what kind of cars they had. Anyway, I'm sure it's really old. Well, it was black and white, so there's one point about it. So yes, it was pretty old. So the store's been there since 1900, basically, and they built from there. So when you think about what they own the land, and they own those parking lots, and they have rights to the areas, and they've got land rights and parking rights and zoning done. All that's been done in a time when you could never do that now. That has value too. That has a lot more value when you're a real estate developer, when you have all these exceptions that have been made and all this extra space in your allocation, and you've got an anchor spot in the mall. I don't care what happens to the mall. I don't care what the future of malls are. You've got the best spot in the mall. That's worth something right there. So they have good, valuable real estate, and also after 100 years, they paid their mortgages. They own these things outright, and that's also super helpful. So that's why I like Macy's. And today we talked about LNG. I gotta wrap this up shortly. So I like Macy's, I like LNG, I like IMAX for a comeback. These are all good price stocks. I don't want to really add things to the portfolios. I think this is short-term portfolio is down 90%. Tesla's killing us again. Look at that, $350,000 loss. That just cost us all of our gains. Tesla flipped negative on us. Now, we were supposed to stop out. I know I mentioned that at some point. I forgot when. We never followed through. We should have stopped out because Tesla was down at 330 or something like that. And I mentioned at the time that we should stop out, but it was popping, and we didn't get back to it, and that was the end of it. So unfortunately, we should have cashed out then and just taken the money. Yeah, because we look at where we were just like recently, and in September too. Even after the spike up that burned us, it came back to 330, and we knew that was support. Again, it's support in the channel. We were hoping it was going to break down, but you can't bet on hope. We have to be reasonable. We should have stopped out at 350 and said, okay, you know, we'll see how high it bounces and we'll start shorting it again. Instead, we're riding it out, which isn't as much fun. Probably it's going to fail here at 450 and start heading back down again, and then maybe next time it'll break below 350. But we actually want it to be 400, the way we structured our bet, because we sold the well, we had two bets, but in the one bet we sold the short-term 400 put, so we don't want it to be too far below 400. That hurts that bet. But in the STP bet, we're much more aggressively short, where we are. We have the 380. We sold the short 380 calls. We sold the 190 puts, so we don't want it to be too low. Well, I'm sorry, we own the 190 puts. That's my bad. We should have gotten rid of those too. We own the 190 puts, and we also sold the 300 puts. So we are looking for the zone right in here. We're looking for the zone between the short puts and the short calls. So below 380 and above 300. That's our target for January. So I think we're right on track, frankly, but it's a very painful track to be in. We needed to finish right about 350. That's our target. So this thing here is well, September. So you think October, November, December, January. We're betting this far out that we're going to hit this line. So we're betting that it's going to dribble around here and then eventually start falling at some point, but not too harshly, because that'll hurt our bet. The nice thing is, though, if you know, there's so much premium here that this wasn't much fun to cash out, but the next time it cashes out, they'll also lose a lot of their premium, so it'll be a good time to cash out the next time we test that area. But anyway, so that's the short-term portfolio. On the bright side, and don't get that's a hedge that for the long-term portfolio. On the bright side, the long-term portfolio, which started out with much more money, is now oh my God, really? 112%. That's insane. Wow. All right. So last month, that's just a crazy thing. So anyway, so 112% is what? Is a huge amount of money. It's up 600. It's up on $560,000. That's how much it is. $560,000. It's ahead, minus 100,000. Let's say for the short term. So you're at 460,000 net dollars for the year on the two portfolios. But we were up $800,000. It's just that Tesla is currently killing us, but it's killing us in a way that it's locking in these gains. Because if Tesla drops with the rest of the stocks, we're going to pick up money faster on the downside than we're going to lose it here. So we're in phenomenal shape. And again, phenomenal shape for sticking with it. I did say when we were at 1.4 billion, 1.4 million, not 1.4 billion yet. When we were 1.4 million. That was just such a ridiculous amount to gain for the year. It was over 100% in the two portfolios. I said, we got to get out of this thing. It's silly. Right there, 1.4. So up 260% since June. So that's how our sum has been. We gained another $260,000. And every time we hit this, I keep saying we should stop out. If we get back to 1.2 million, we should stop out. Well, we just went below 1.2 million. Here's the STP. Oh yeah, see, look, we were up 300%. Now we're down 100%. We lost $400,000, all because of this stupid position right here. We had a $400,000 swing in this position. It's still a good hedge, but it's a very annoying way to play. It's just unsettling to go up and down like that. Where are we? Long-term portfolio, right? So that was 979 on whenever it wasn't that day. Oh, here, this will tell me what day. That was September 1st. Really? That doesn't seem right. Something wrong with that link. That just linked me to like Phil's the master list of my stuff. That's not the right link. Anyway, whenever that was, August, whatever it was, August, middle of August, we were at 979, and now we're at 1063. So we gained almost $100,000 in the last month. So that's kind of crazy. Oh, I'm sorry, and that's in addition to, so we were at 979. Now we're up another $100,000, and that means it's just crazy. So yeah, so we haven't cashed everything out yet. We decided to cash out things. IBM, Joe, and Stars were too profitable to leave open. That's what I said last time. IBM was up 71%. Joe, which is coffee, 91%. Why risk it? And not Stars, Constellation Brands. They're up 74%. So there's no point in risking those. They already paid off. FCX could go lower, so we'll kill it. We were worried about them going lower. We already have gold for commodities. How did FCX do since then? See, I like to, this is what I do the reviews for. I like to see if I knew what I was talking about when it happened and see if I made a mistake. So no, FCX kept going up. And again, it wasn't like life and death. The point was it wasn't worth risking. Where did I talk about FCX? Hang on, I'm confused. Oh, FCX is up there. So FCX was up 60%. I didn't want to risk it. It's too fickle. And then Tiffany, I'm like, why do we have Tiffany? What were we thinking? I don't know. I don't remember why we picked up Tiffany in the first place. So that's the end of that trade. I literally couldn't think of a good reason to be still in it. So I was just like, forget that. See? Oh, because they were getting bought by the guys. That's why they were in that thing with LVMH, and I thought that's why we played it. We played it because we thought they were getting bought, and then I started thinking that this was done. There you go, and it was, and now see, that was the problem when you're into an M&A play and you're not sure it's going to go through. You don't stay with it. So we lost our premise. We weren't sure it was going to happen. We thought it would be good to, and it was only the $100 puts. It's not like it was that risky. We sold the $100 puts for 9 because LVMH put in an offer for them much higher than that. And I said, well, that's an easy way to make money if the deal goes through. But then last month I said, well, why are we still in this trade? Because the deal looked shaky, and now it's completely collapsed. And again, pay attention. If you're not reading up on your things every day, if you have a stock in your portfolio, it is your job every day, not even every week, every day, you should be doing this. You should at least go to Yahoo Finance and at least read the last bunch of articles that were on it, or at least look at them and say, what's going on with my stock? Camilla Harris, Timberland, who cares? Dress Barn, who cares? Although it's a retail thing, that's why it's there. Thanksgiving Day Parade will look different. So they're not having the big Thanksgiving Day Parade, but they don't make money on the Thanksgiving Day Parade. They have a TV thing, but it's not, that's not a money-making thing. It's good advertising for Macy's, but it's not like they make a lot of actual cash money from it. So it's not an event, it's negative. Macy's Fall Fashion, Macy's in the City of New York have again, Thanksgiving Day Parade. Black Friday shopping is over, and it's like, okay, I can see why we're down, because people think this can't happen anymore, and it shouldn't, but eventually it'll happen again. Retailers are closing. That's good for the survivors. See, I might want to read that one, although I've already read 10 articles like it, but that's Barron's. And so the point is Macy's going to be a survivor? Yeah, probably they are going to be a survivor. Then what happens when their competition goes out of business? Lord & Taylor's gone. J.C. Penney's is gone. You know, people, big guys who do compete with them on a mall-to-mall basis are gone, forces more shoppers into Macy's. In tough times where, oh, that's a great article. I want to read that. Tiffany's in big trouble without the takeover. Okay, we knew that before it happened. How is Macy's reacting to COVID? What's going on with Macy's options? These are great articles. You got to read it, but these are 2 weeks worth of articles. You got to read these every day when you have a stock. If you don't have time to read about the stocks in your portfolio, you shouldn't have the stocks in your portfolio. So what else did we do? I'm just trying to find things we took action on. PAA, like them. Berkshire, let's buy the short June 30 puts and to reduce the risk to the overall spread. So what was I doing there? Berkshire was BRK point B. Damn it. Oh, it's dash. What a lot of stuff you have to remember. It's like, wow. All right. So I just didn't want to risk, if the S&P collapsed, I didn't want to risk getting hit with a big put number, so it wasn't worth it. So because the puts in that portfolio are not just, it's not just these. Almost all of these positions have puts in them. So when I want to pull out some risk, I can buy back puts. So in this case, we didn't do it. It's not logged in yet, but in this case on Berkshire, we have sold the 130 puts, and they're up just like the other puts. They're up 70%. Kill it. Take the 70% and run. It reduces a very large risk in our portfolio of owning 500 shares of an expensive stock. So that means we can more easily ride out a downturn. It means that our hedges become more effective because we have less to hedge against. All right, Caterpillar fine, Cisco fine. Well, it wasn't that fine. Oh, I'm sorry, it already dipped, so I wasn't too worried about it. Took an ugly dip, but should do well. There you go, see? I'm so consistent in my thought process, it's amazing. Harmony, wow. Oh, it made 28,000 out of 30,000, so why leave it? So why not do it? Macy's, let's buy back the short calls. See, so I said, why do we buy back the short calls? The short Macy's calls were the January $20 calls. Oh, I think we just bought them back to clear the table because they were useless. And what I wanted to do is on a move back up, I want to sell some calls. So there's no reason having this dead weight to carry around. We didn't get a big move back up yet, but back to Macy's. So that was this part of August. So we're not getting a big move back yet, but I am expecting to start moving up and we have a nice chance to sell. So that's Macy's. So we didn't make that many moves actually. I mean, see, it's funny because as much as I want to kill, let me get small. As much as I want to reduce positions, these positions are just too freaking good. Look, nothing to sell there. Viacom, I still love them. We can do better. Oh no, really? I'm like so sad. I love Viacom. We still 43 out of 50,000. We can do better. So let's kill this one and hope for another opportunity. What do I mean by that? We can only make $7,000 more out of 50,000 potential. There's only 7,000 left to gain on Viacom, And that trade, which is right here, is we have the 515s. It's already at 26. So there was no reason to keep going. It would have taken us 2 years. These are January 2022s. It would take us 18 months to get $7,000 from 43,000. We obviously make much more money than that. That is not a good return for us. So we had Viacom that we decided to quit. VIAC, and they're still going up. But that's okay, it just wasn't going to pay us enough. I'm happy to get back into Viacom. I was hoping they'd come back down, but they haven't. And then you've got, what was that last one that we did? Damn it. Come on, brain. Valero. I'm not confident enough to stay in Valero. VLO. And rightly so, right? So that one dipped down. So, you win some, you lose some, but the point is you're reducing your risk so that we're more flexible, we have more cash on the sideline. WBA, another one I love. It's fun having stocks you really like in your portfolio. Great for a new trade with another downturn. And that was nothing. That was only here. Now it's definitely here. I freaking love these guys at that price. All right, so that's it. I mean, we didn't have as many reductions as we really wanted, but on the other hand, we are so super hedged in the short-term portfolio, and if Tesla ever comes down again, we will be in great shape. But look at that, holy crap. See, that's why you don't play on a Fed day. But we hit what, oh, look what happened. Look at that, speak of the devil, 34.20. And rejected once again. See, you don't need to see the chart. We already know what the chart's going to look like before it's printed, and that's how you make money trading, not waiting until something happens to look at a chart. That makes no sense. That only tells you where you've been. It doesn't tell you where you're going. And it's not just, but again, it's not, I guess that's the point of the whole lecture today. It's not just the math. The math tells you the math tells you the parameters of where the range is, but then you've got to apply the fundamentals to the parameters and say, okay, we're low in the channel, we expect to be in this trading range, and these are the factors pushing it higher and lower, and therefore I think at this moment it's more tending to go high than low. So I look for stocks in the bottom of their channel where the news flow is trending my way, and I think that the overall environment is good enough for them to make progress. That's how it works. All right, out of voice almost. Let's see. Any trade for man? The Fed's up. Macy's, look at the debt. Okay, Bernie wants to make a case against Macy's. Ooh, that's hard to read. Let's see. He cuts off here. They got a lot of debt. Okay, anyway, they have a lot of debt. That's normal. They always have a lot of debt. They're like, it's like AT&T and people, same thing with AT&T. People are like, oh, look at the debt. It's like, they build things. They invest in infrastructure. Macy's is going to carry debt. Obviously, it's about the cash flow. Oh, and that was important too. Let's see if we can find that out. That's what I care about. Is what about the cash flow? So let's see if we can go to the cash flow statement. Now, don't forget, Macy's plays a big dividend, but cash flow from operating activities. Well, net cash flow, let's talk about that. Net cash flow. Let's see how they did here. Yeah, look at that, 2 years, down $6 billion in 2007, 2008. That was painful. Then since then, -3, -1, -1.2, -1, -2, -1, -1, -2. Wow. Oh, I'm sorry, it's not the net. I'm like, that would be terrible if that was net. Okay, let's get back to reality. So in 2007, 2008, it was not that bad. It was +9, -6, 7, 3, -2, 1.3, -9, -1.991. 437, -27, -1, 132, 179, -265, -517. They are restructuring, they are rebuilding their stores, they're changing things in order to take on Amazon. All right? And yes, they do take on a lot of debt to do that sort of thing. But I'm not anti-debt as long as it's being done for good reasons. And I think they stopped paying their dividend, which I approve of in this case, because why should you pay out that kind of dividend? Yeah, forward dividend and yield. They last paid their dividend in March. I don't think they're paying it anymore right now. And that's good though, because they pay out way too much money in dividends. Financials. I'm not going to say it here, I don't think. Balance sheet. Ugh, I hate the way they change this thing. Can't tell anything's going on here. Cash flow. Used to be really nice to read. Now they've completely screwed it up. Nope. Can't even see the dividend. Anyway, repayment of debt here, issuance of capital stock, interest paid, investing cash flow. Anyway, I mean, look, it's always a good point. They do have a lot of debt. That's why people don't like it, but it's not any different than their normal operation year after year after year. So it's not for you, that's fine. But I mean, I don't mind that. It doesn't scare me off. They can afford to pay their debt. That's what I care about. And especially if they kill their dividend, that puts a lot more cash in their pockets. Brian says, Russell up 2%. Why does everybody insist on dumping text into here? Dow jumps 300-point session after the Fed projects keep. Yeah, but we know that. That's the same thing they said already. It's not enough to. I don't think it's enough to get the S&P over 3420 to stay. I think that this is a reaction to the Fed. You got that. You got your stimulus, but now what? What's going to happen next to keep us going? All right, so that's what we're going to have to find out. We'll watch it next week, but it's not changing my mind. Nothing that happened changed my mind. That's the bottom line. We're going to do more portfolio reviews. It's not going to change much. So as you know, we just went over the long-term portfolio. I'm very happy with these positions. And why wouldn't I be, right? We added 10% to the portfolio in a month, and 20% off the base in 1 month. Made $100,000. We started the year with $500,000. We added 20% in a month to the portfolio. So it's obviously there's nothing to be upset about here. And we will just keep moving forward. All right. So thanks a lot, everybody, for coming. I appreciate it. And we will do it again next week. All right. Take care, everybody.